Hello traders, this is Reagan. Welcome to High Fund Investments. We're going to discuss risk management. Critically we put our emphasis on lot size. I put my emphasis on risk management because I know managing risk without exceptions is one of the key things you need to put in line so that you be profitable as a trader. And one of the key things you need to do consistently, whether you have been in the market for a very long time, it's one key pillar you need to follow every day and you are in the market. In a matter of time, let's go to lot size. Lot size helps you manage risk very well. Lot size helps you manage risk very well. Understanding it is very crucial. And then lot size helps you to, as a trader, you are able to understand and you trade very many pairs, very many currency pairs, whether they are volatile pairs or not. If you understand lot size very well, you can trade various currency pairs. Let's take and then the other key thing is that one of traders misunderstand lot size and then end up blowing accounts, but here today we are here to make sure I understand this better, well, loud and clear. There are four types of lot size. And let's start with the smallest lot size, which is very rare, which is the nano lot. Nano lot size is very small. It is very rare. Actually, very few brokers offer nano lot size. Nano lot size means nano lot 0.01, which means each pip value is 0.01. If price goes into your way, you are losing in each pip 0.01, and if you are making profit, you are losing 0.01 per pip. Let's take an example over here. If you are risking 2% of your account, I always encourage to risk 2% of the account so that the account is able to sustain losses. If you are risking 2% of your account, 2% means multiplying 0.02 on your account. Let's take an example of a $500 account. You multiply 0.02. The answer you get, which is $10, is 2% of your account. Let's take an example, a scenario where you have 2% of your account, which is $10, and then you are trading a very volatile currency pair, or you are trading an index, which is US30, and then your stop loss is 1,000 pips. If you divide your risk, which is $10, by 1,000 pips, the answer you get, which is 0.001. This is the pip value. That means each pip value is going to be 0.01. Each pip value is going to be 0.01 per pip you lose or either you gain in profit. That means the lot size you need to the correct lot size you need to use is the nano lot. Very few brokers offer the nano lot, but in the future we shall share very many various legit forex brokers to use. Let's go down to the second lot size. Which is the micro lot. Micro lot means 0.01. Micro lot means 0.01. A micro lot means 0.01, which implies that each pip is going to be equivalent to 0.1. If your pip is equivalent to 0.1, that means the correct lot size you need to apply is the micro lot. Which is 0.01 on your MetaTrader 4 or MetaTrader 5 on your trading platform. You're going to be using 0.01 as your lot size to use, which means each pip value is going to be 0.1 per pip. You make a profit in 0.1 per pip, and then you make a loss in 0.1 per pip. That means that if you are trading a $500 account, which if you have a $500 account, if you have a $500 account here, which is $500, and then we multiply by the risk, which is 0.02, which is 0.02, and then we get $10, $10 right here is the amount you risk per trade. Let's take a scenario where your stop loss is 100 pips. That means you're going to divide $10 over here, the risk per trade. You're going to divide it by 100 pips. Here you are calculating the pip value, which gives you the right lot size to use. If you divide this by 100 pips, you're going to get 0.0. You are going to get 0. You're going to get 0.1. You're going to get 0.1. 0.1 in pip value right here. It means the collateral size we're going to use is the micro lot. This is what you put into your MetaTrader 4 or MetaTrader 5 platform. Whether you are using another platform to trade, this is where you put into your broker to make sure that you lose or you make a profit knowingly, which means here that you are making $0.1 per pip, $0.1 per pip, and then you are losing $0.1 per pip. Let's go to the third lot size. The third lot size over here, which is the mini lot. Mini lot means 0.1. Mini lot means 0.1. This is what you put into your MetaTrader 4 or MetaTrader 5 in your trading platform to ensure that you use the lot size. You understand? Mini lot means 0.1, which implies that each pip value is going to be equivalent to $1 per pip. $1 per pip. Micro lot means 0.1, which implies that $1 per pip in value. You're going to make money, you're going to lose money in $1 per pip. Let's go back. Let's put it loud and clear over here. Let's take a scenario. In our risk here, which is 10%. Which is 2%, which is $10, which is 10 USD. Then take a scenario. Let's take a scenario where you are risking 10 pips. We are risking 10 pips. 10 pips, you divide it by the $10. By the $10 here. The answer you get which is 1. You are going to get 1, and here you are calculating the paper value, and you are calculating the paper value, which means that the correct lot size you are going to use, which is a mini lot, is going to be 0.10. This is what you put into your broker, and this implies that you have entered in a trade with a mini lot size. You are trading knowingly, which implies that you're trading professionally. And let's go to the last standard lot size. The last lot size, which is the standard. Lot size. Many traders want to use the standard lot size, which is huge, which implies that trading professionally with the standard lot size means that your account has to be quite bigger enough, or else if you are trying to fix a standard lot size on a smaller account, you are increasing risk. It is hard, it is not professional to trade with a standard lot size on $100 account. Let me repeat, it is not advised, not at all, not even anywhere, to apply a standard lot size on $100 account. Doesn't work like that. And then trading with the standard lot size means that a 1.00, this is what you put into your MetaTrader 4, MetaTrader 5, according to the trading platform that you use to trade. This is what it means by standard lot size. 1.00, which implies that each paper value is going to be equivalent to $10 per pip. $10 per pip. This means that each paper value is going to be equivalent to $10 per pip. This is quite huge. That means if you are trading a $100 account and you have applied a standard lot size, that means in just a matter of 10 pips minus the SIP rate, your account is going to be blown up. So it is very important to understand lot size so that you stop blowing accounts and then elevate your trading skills without deviating from the system. Let's take an example. Let's take an example. Our risk here, which is 2%, of $500 account. 2% means you calculate the account. You multiply 0.02. The answer you get here, which is $10, is the amount you risk per trade. Let's say you have this is a $10. This is the $10 over here. If you want to get, or if anywhere else you calculate, and then your technical analysis giving you, let's say 2 pips, smaller pips, or 3 pips, or even 1 pip, this puts you at risk or in a moment to use a standard lot size. This is where you need to take a step back and look forward and rethink twice to make sure you are using a correct lot size, because standard lot size is quite big. It has to be used professionally according to the equity non-to-play account and knowingly. If you divide, some traders who want to trade new, some traders who over risk in their account, if I have $10, then divide by the pip, by 1 pip over here, this gives you 10. You just get 10 here, 10 in pip, 10 pip value, $10 per pip in value, $10 per pip in value. which means that every trade you open, the trade you are in, you're going to make money with a $10 per pip, and then you are going to lose money with a $10 per pip. That means if price goes up 2 pips, you are losing $20, and if price goes up 2 pips, you are making $2 in value. The next video is going to be about position sizing. I'm putting my emphasis on risk management, because I know if you have a strategy which is 90% with a 90% win rate, with the poor risk management, you have nowhere to go as a trader. In just one poor trade you get wrong can blow the entire account. So I'm putting my emphasis on risk management. The next video is going to be about position sizing. My name is Reagan. This is High Fund Forex. Please like and subscribe not to miss out the next content. I'm working on an entire Forex course. Thank you. Trade professionally. Happy trading.